Awesome.
Let me know when you're ready. You ready? Cool.
Yeah.
All right. Hello, everyone. I am your host, John Rayan, and my guest today on the Always Direct podcast is Lane Kawaka. By the way, is your name is that how you pronounce your last name? I forgot.
Kawaoka, but the important thing is simplepassivecashflow.com. That's all that really matters.
I know, but I don't want to butcher your name, man. Say it again for me.
Kawaoka.
Kawaoka. Got it. Hello, everyone. I'm your host, John Rayan, and my guest today on the Always Direct podcast is Lane Kawaoka. He's an industrial engineer. He's a podcaster. He's a real estate syndicate, and he's an all-around rock star. And I'm very happy to have him on the show. Thanks for coming on.
Hey, thanks for having me, John. Aloha, everybody.
Aloha, man. So, Lane, I mean, you do a lot of different things, but basically, in the end of the day, simplepassivecashflow.com is your main journey right now, where you help people figure out how to make money without getting caught in the rat race, essentially, correct?
That's correct. We work with, more high net worth working professionals and successful entrepreneurs to invest in real estate to get all the good tax benefits, better returns in Wall Street without all the nonsense of flipping houses and wholesaling houses that kind of geared it up for more broke guys,
Yeah. Less risk for sure. And I'm on your website, and it says you have 4,800 units currently.
Yeah. So, today we kind of operate large apartment complexes. So we usually buy them in sets of 100 or 300 units. But, I think today, we kind of take it back to the beginning, right? Because a lot of, we've kind of scaled up my business using third-party property management. But that first rental, that's the hardest one, right? Just getting started.
Yeah. So tell me about that. So how did you get started?
Yeah. So I kind of grew up on this linear path, be frugal with your money, go to school, study hard, eventually became an engineer, realized that that day job kind of sucks, right? Like who really likes that, working for the man, long hours, being the new guy, I was always working on the road. So I was never really home. And, again, following all this financial dogma that we're taught to do, like invest in your 401k, buy a house to live in, which I don't necessarily agree with these days. But, I bought a house to live in, was never home. So I just started to rent it out. And to a young 20-something-year-old kid at the time, that was all beer money. And that's where I got this taste of cash flow. And I realized if I just did a handful of more times, I'll be able to quit my job and fire my boss.
Everybody's dream, right?
Right. How long have you done?
And this was in 2009 is when you started doing that?
Yeah, bought my first rental in 2009. Just kind of got that taste of cash flow and got more sophisticated about it. Started to buy more for where the numbers made sense, as opposed to, I think most investors invest more of appreciation, which I consider gambling, right? So we look at properties that meet this 1% rent to value ratio, where you take the monthly rents divided by the purchase price, and it needs to be 1% or higher. So for example, $100,000 property renting for more than $1,000 a month is kind of what we're looking for, so that we are positive cash flow every month after expenses, repairs, maintenance, professional property management, because we don't want to be landlords, we're investors.
Yeah. So you started out in 2009, and then you started buying more homes, or did you go to multi-unit, or did you start taking on investors? Can you go through the journey with me on how you got from? I mean, that's not that long of a time frame. We're talking 12 years ago. It's nothing.
Yeah, so from 2015, from 2009 to 2015, I was just working my engineering job, saving maybe 50, 100 grand a year to just plow right into investments as down payments. 20% down payments is kind of the way we do things. No tricks, no games, none of this no money down stuff. That's for to sell hope and dreams to guys without money and screw them out of $30,000 education programs, right?
Yeah.
That's not what high net worth working professionals do, or people who actually make a professional wage do. Or in your guys' case, successful business owners, right? Your guys' highest and best use is growing your business, but you can be optimizing your money by passively investing on the side with this stuff. So that's what I was doing as I was working my full-time engineering job. And in 2015, I had 11 of these rental properties. So about that time, I started to realize that, as I became more of an accredited investor and started to interact with more accredited high net worth investors, that when you get to be, net worth over $1 million or even $500,000, owning these rental properties are kind of a pain in the ass. They're cool in the beginning, right? I mean, they got me from zero to $500,000 net worth, but with 11 properties, just to give people a little insight, like I had maybe an eviction or two a year, some kind of big catastrophe that happened every quarter, like a tree falling on the house or plumbing repair, um, things that it's not that big of a deal because the property manager take care of it. But, with 10, 11 rentals, I had maybe a few $1,000s of passive cash flow a month, which is awesome. But I don't know what American family can survive off 3 grand a month. You're gonna need more like 10,000 plus. So therefore, you're gonna need 30 plus rentals, and therefore multiply that exception rate by 3. So now you're talking about an eviction every other month and some kind of big catastrophe every few weeks. And then this is where I learned that high net worth accredited investors go into these private placements and syndications, larger deals, more institutional assets ran by a professional general partnership group that have skin in the game, better tax benefits, better leverage. Everything's better except, well, who do you trust, right? Because it's really predicated on the people that you work with. And, it's unless you have a circle of peer investors around you, it's really hard to break into the circle.
Sure. Now there's the Grant Cardones who are everywhere, and then I see bigger pockets podcasts. I forget his name, but he's on there. I see a picture behind you. I mean, yeah, I mean, he seems like you guys are doing the same type of thing, correct? You and the bigger pockets guys.
Well, the bigger pockets guys kind of cater towards the broke guys, right? The guys doing it themselves, and they don't have good paying jobs or successful businesses, right? They're kind of the Joe's making 50 grand a year or less. And so a lot of their message is, doing it a lot yourself, like don't get a property manager, save the extra 10%, right? Is kind of their message. It's kind of a scarcity mindset, in my opinion, where a lot of the people in my tribe, we make good wages. Like most people are 6 figures and above, right? Time is more valuable to us. And like, we don't need the top returns. We just want to preserve capital, grow money tax-free, and kind of, our highest and best use is likely at our day job or running our business or growing our business for the most part. So that's kind of where we come from, right? Grant Cardone, he's kind of like what we do, but he's just a marketer, right? He's just the marketing side of the business.
So personally, I have 3 apartment buildings myself. Me and my brother, we're partners. We have 38 units spread over 3 apartments. We never got into single family because we felt like there's too many individual heaters, AC units. You got to drive to 11 different places. I mean, it's like a lot of you're spreading your eggs. It's easier to get out, but we always felt like it would just be easier to manage if we had them all under one roof.
No, you're exactly right. The problem there is like you guys are very astute business operators, right? Most people don't have that business acumen to be able to do that. They should screw it up on a single family home before they blow all their money on something big where you can really mess up, right?
Yeah.
And then, and what you're doing too is you're getting above like the mom and pop investors out there, right? A lot of people own rental properties and a lot of people bid them up and the pricing is kind of stupid.
Yeah.
So that's what we kind of do. We stay above the mom and pop investors. We stay above 60, 100 units. But we stay below the institutional players buying 300-400 unit properties. There's a nice little sweet spot for folks like us, little syndicates, to buy these run of the mill or the intermediate kind of level properties.
Sure. You're not competing up against huge money, and you're not competing against the people who don't have much money. You got that middle ground. But I really want to go back into this and ask you, Lane, about. So I don't want to say I have a scarcity mindset. I probably come from a very similar background as you, immigrant parents. I work hard, save your money. If you don't manage it yourself, you're going to lose it. If you don't run the restaurants yourself, you're going to lose it. If you don't manage your properties, you're going to, you know what I mean? You're going to lose everything. So we decided that it's easier for us to manage it ourselves just because we live close to the buildings. But how do you get somebody like myself who, doesn't pay a management fee, probably could and make less, but how do you get out of that mindset? Because in the meantime, I mean, I don't know. How did you go from where you were to where you are now? Like, how did you change that shift, make that shift? What changed your mind about it?
my net worth grew to a certain point where I kind of got over it.
Yeah.
So today, I mean, what you're talking about is very common, right? The
Yeah.
immigrant mentality or the frugality mentality. I mean, it's awesome. I used to have that too, right? I mean, people go to my website. I have a laundry list of the really like shameful things I used to do to being a cheap ass. Simplepassivecashflow.com/cheapo is the URL. People want to go there, right? Like I would like take a shower at work to save money. I would charge up my power banks at work, do all kinds of stuff, right, to save a buck here or there. Use the bathroom before I leave work, like silly things. Um, and looking back on it, and now I help out family offices kind of take it to the next level from $1 million to $10 million net worth is kind of the goal of my organization these days. But the immigrant mentality, the frugality mentality, it's good, right? Because it teaches you the right skills and it teaches you to be lean and run good business practices, right?
Yeah.
Money is sort of interchangeable with time. And if you're lean on your money, you're lean on your time, which is your business systems. But after some point, and I would argue maybe around $500,000 to $1 million, there's a paradigm shift that when you need to start to play nice with others, you need to start to collaborate, right? Because at that point, you're just going to start to grind it on your own. And from what I've seen with second, third generation wealth families that take it to the next level, they are very, not really, I wouldn't want to use the word abundant scarcity, but they are very collaborative with other people, right? They give freely, they associate with the right people that are kind of givers too, as opposed to takers. And there's a great book about this stuff called Givers and Takers, right? Some people, when you start off, you're very frugal. You've got the immigrant mentality and you're kind of taking, and you don't want to really give because you're still in that mode where you're putting the oxygen mask on your own, right? And as they say in the airplane, you put the oxygen mask on before you help others. But where does that transition point come, right? To me, it's somewhere between $500,000, $1 million net worth. Some people don't get it, and they grind up to $3-4 million, and they finally wake up and get it, right? But whatever that is for you, or where your transition point, I don't think that that's where you really achieve the next level of wealth. And wealth being, your which is the social capital. That's really the currency of the wealthy.
Yeah.
And the good deals that comes along with it.
Yeah. So tell me, how does this work? So how does it work? You take investments from people, and then you go or people bring you projects that you sift through, and then you take all the money that you're getting plus your own money and you're investing it and guiding the whole thing. You're controlling the whole situation, the contracts, the disbursements, everything is handled through your office. Is that how it works?
Right. I mean, people have never heard of a real estate syndication or any syndication for that matter, right?
Yeah, most people have.
Essentially just pooling your money together, sort of like a stock or IPO offering. The analogy I like to use is like an airplane. You have the cockpit with your general partners. These are the guys that find the deals, use their relationships to get the lenders on board, get the operation team on board. A lot of times they're the people putting in the debt in their own name. I'm the one who signs on all the debt for our projects. And then passive investors can come in, just like in Coach, pay their ticket to get on the plane, sit back and relax and not do anything and cash your checks. That's essentially the system. This is the difference between average folks who invest in the retail investments, like in the 401k, like a mutual fund or stock, and the people that are in these country club deals, such as private placements and syndications, right? High net worth wealthy people own a piece of businesses, and that's what this is, not just some common stock thing.
Gotcha. And and this is for all of us to understand, what's the difference between an accredited investor and non-accredited investor? What's the process to become accredited?
Yeah, so there's no process. I mean, if you go on the SEC website, essentially, and I might be butchering this, but as accredited investors, you have a net worth of $1 million or more, not including your primary residence. And I think you got to make over $250,000, maybe a little bit more if you're married. But you need to be a semi-affluent person in a way. But it really doesn't mean anything. Most of the deals, I mean, the vast majority of them are available to non-accredited investors. You just need to be in the proximity and have a pre-existing relationship with the sponsor of the deal. The only reason why people think that you need to be accredited for all of these deals is because once a deal is mass marketed, the government's like, you, Mr. Syndicator, can only take in accredited investors at that point, because what the government wants to do, and this is pretty typical of the government, right? They're trying to protect the unsophisticated Johnny boy investing his only $25,000, $50,000 into do it, potentially losing it, because Johnny boy doesn't have a network and he's just going to invest in a sucker deal, going out to guys like himself. So, but it's a sad thing because, most deals are, they're pretty solid, especially real estate deals where it's backed by a hard asset. This is what the average person needs the most, right? This is how you get to be accredited status. But in a way, the government has its rules structured to kind of only make it easy for the higher net worth people to get involved.
So, if you were to talk to a gentleman who's, let's say, 25 years old, and he wants to start investing in real estate, would you? And he's only making $50,000 a year. Would you recommend to him to not start investing in real estate, to figure out how to go from $50,000 to $100,000 a year to bring in more income before he starts investing, or would you say live on $25,000 and save the other $25,000 to invest? Would you rather increase your monthly revenue or yearly revenue in order to live comfortably and invest, or would you just say be frugal like you did?
Well, it depends, right? Like this particular gentleman who's kind of at square one, does he have the ability to make $100,000 a year, right? Or is this guy kind of an idiot? Like, I guess I'm asking you this.
He's probably going to have to slave away a little bit. He's going to probably have to work 3 jobs and hustle. It's not going to be an easy.
Yeah, if his upside isn't that high, right? Like that, I'm not a big fan of college for many reasons, but that's, dude, go to college, get a higher paying job. That's one way of doing it, right? Most people, I think you and I might say, well, entrepreneurship is a solution, right? But most people fail, right? And this guy may not have the business acumen to do that.
Yeah.
Right. But I just don't work with folks like that, right? I work with high net worth professionals,
right.
Guys with already good paying jobs, already done through the college drag and everything, or they're successful business operators. We work with those type of people. For the gentleman you're kind of mentioning, right? I don't know. I'm not the person to ask, man. That's why they have all these like Susie Ormans and Dave Ramsey advice, right? The financial advice for the masses. I don't do that. I work with people who are like good financial sense. They don't spend more money than they make. They save money. They're prudent with their cash, and then we take them to the next level, right? We work with the top like 10%.
Yeah. How'd you guys do in 2020 with the moratorium and everything? Did you guys have any issues with that, or did most people pay?
Yeah, most people pay. Normally we collect 97% of the rents. Maybe at the worst of COVID in April and May went down to like 95%. We still make money if we stay above 70%, so no big deal. But that's why we invest in this type of sector. Like we focus on workforce housing, so it's not the luxury stuff, right? Because the idea in tough times is the luxury people move into our more value-based apartments, renting from $700 to $1,200 a month. Another factor is we invest in red states. Not to say anything politically, but we want to be on the landlord-friendly side instead of the Socialist Republic of California, for example. Another thing is, we invest in emerging markets, places like Phoenix, Arizona, Dallas, Texas, Houston, Texas, Atlanta, Georgia, places like that, where you're doing typically better than the average of America.
And you run a mastermind, don't you, or a group? Can you tell us about that?
Yeah. So it's the Family Office Ohana Mastermind. There's a lot of groups out there that kind of teach you how to do this stuff, which I think are kind of scams. They charge you like $30,000, and maybe 5% of the people are successful into being real estate entrepreneurs. But there was nothing for the high net worth, already successful business operators who are already had several $1 million net worth, but they just wanted to get a little smarter with in terms of what deals to go into, building a network of other pure passive accredited investors, what tax like loopholes are there, what best practices there are legally, and then to build that community and network with other like-minded people about the same net worth and trajectory financially. So that's why we've kind of created this family office group, right? Because family offices are $100 million net worth families and above. Quite frankly, myself and a lot of people can't afford that, right? But what do you do when your net worth is $1 to $10 million and you're trying to take it to the net next level? Well, we've created that niche product for those types of individuals because community is so important, right? You, like I said, we said before, you can grind it to $500,000. And quite frankly, I don't want to work with anybody until I've seen them pass that grind stage and show their business acumen and stuff and business worth, getting them up to that $500,000 net worth. But to take it to the next level, you're going to have to throw it into a different gear. There's a different strategy for that.
Definitely. I mean, it's not easy to, to live within your means, to spend less than you make, to save it, and then to actually put it into something that either it's your first time doing it or not. It's scary. It's scary.
It's a lonely freaking world, man. Right? Like your parents don't do this, your family, your coworkers at work don't do this. They're all brainwashed to do the same thing. 401k, stock markets, that only make Wall Street rich.
I know. So tell me why you don't like. I personally don't like college either. But tell me about college. Why are you against college?
I mean, I think it's okay. I mean, for me, like I dog on it a lot, but like for me, it got me a higher paid salary out of college, which I parlayed into,
where you are now,
into real estate investment. But as we put together projects, bring on, engineers, architects, it's funny because all those people are the people who get paid the very least out of these deals because they're very replaceable, right? I can replace a project manager like that. I mean, I used to be one.
Yeah.
I know who to hire, and I probably wasn't the best engineer back at the time, but in the entrepreneurial world, like you're not paid based on like a commodity occupation. Your commodity occupations with colleges are really good at churning out these kind of products are very compensated very well. And I mean, if you want to go get a job like everybody else, college is really good for that. That said, most people really aren't really smart business wise, and they probably should go to college, right? If I had 10 kids, I'd probably send 9 of them to college because only 1 out of 10, even with all the opportunity in the world, probably wouldn't really have what it takes to get a really business going in the right direction. I'm lucky because I do real estate. Real estate is pretty easy. You buy the right asset, it kind of does it on its own. But the stuff that you guys do, I mean, the failure rates pretty high.
Oh yeah. Well, when I started out, I started out with just a restaurant/bar, and then we sold that one, and I decided to just go with restaurants. We started Papa Ray's Pizza in like 2010. We franchised it in 2014. Now we have 8 locations. But we only own one ourselves, and then we franchise the rest of them out. So we advise and we help and we guide and we help them to profitability and we collect royalties and rebates but it's worth it because the amount of money they save by joining our franchise company is enough to cover all of that. So it's a win-win situation. But yes, it's a failure rate is astronomical in my business. Astronomical. Right. But and I don't have it. When you're an entrepreneur, you don't get a 401k. You don't get a health and dental. You got to go figure out how to do that yourself and go buy it yourself. And so when you buy real estate, that is my 401k.
Right. It's a hard asset that you can kind of hold on to, come hell or high water.
I say it all the time. If shit hits the fan, I could just move into one of the apartments, But if it ever got really bad, which I know it won't, but if it ever did, I mean, I always have a place to stay, a place to go, and you can touch and feel it. I'm not going to go up and down with the stock market. The 401k is nice, I guess, but only if it's one of 5 investments that you have,
Right. And you're probably one of those guys. I mean, if you can run a business franchise, you can probably run real estate on your own. But the question is that where your highest and best use for your time is, right? mean, another thing, once you've got it set up, it is pretty simple. But I mean, a lot of people just don't have that ability, the connections to get the good deal flow, and they're buying lukewarm deals out there. One of the tenets that we kind of tell a lot of our high net worth investors is you don't want to be into one deal for more than 5% of your net worth, right? And this is why they don't want to go buy a property on their own, right? They want to be in 50 grand in dozens of deals spread around different geographic locations, different partners, different asset classes, apartments, self-storage, multifamily, storefront, triple nets, diversify, right? In all the sense of the term.
Do you guys have shopping centers under your portfolio?
We primarily do apartments. That's what we operate. But
Yeah.
for myself as a passive investor, I'll invest with other people, maybe with a minority portion of my portfolio, into different asset classes for sure.
Mm.
But all into the sector of like it serves the average person, right? The lower middle class. That's my big investing thesis.
Yeah.
Because in good times and bad times, it performs really well.
Absolutely. And it's such a misconception for a lot of people. People always want to they don't want to deal with the lower middle class because of the headaches, and maybe they're scared, whatever the case may be. I won't open a pizza if they're making too much money in the neighborhood. We won't even consider opening a pizzeria there because they don't eat out. They don't eat the kind of heavy foods we serve, number one. And the real estate we have, it's all blue collar, lower blue collar. And it's just there's always going to be people who need those places to live. So I agree with you, and I'm actually subconsciously doing exactly what you're doing right now. So let's just say somebody puts in 100 grand into the syndicate. How do they get the money back? Do they get checks, or is it just how does it work? And is it easy to get out if you ever wanted to leave?
Well, it depends, right? It depends what deal you're going into. I mean, you can syndicate anything if you wanted to. You could syndicate a pizzeria if you wanted to. Um, the deals that I personally like are the ones that are stabilized going in. So they're cash flowing day one. So that means, quarterly distribution checks based on the cash flow profits. But the deals that I also like also have value add opportunity, right? The ability to rehab units. So we're usually rehabbing, maybe adding $4,000 to $6,000 of rehab per unit, which doesn't sound like a lot, but when you multiply it by 10, 300 or 100 or 300 units, and that's new flooring, new appliances, new paint jobs, playground equipment outside, enough to bump the rents up 10 to 20% across the board. And just like on a business, right, you're increasing the income or decreasing expenses to impact the EBITDA. In our world, it's doing the same thing, but instead of the EBITDA, we call it net operating income. And the price of the property is dictated by net operating income divided by the prevailing cap rate. And that's how much value we create. So we can extract that value via refinance, which is tax-free. And that's kind of the ideal scenario. Get all our money back out so it's infinite returns at that point, and just hold on to the cash flow stream for the eternity. Or if somebody wants to pay a stupid price to us, then we sell it, right? And we go buy 2 more apartments for the price. But that's kind of how I like it, right? Because it's kind of a hedge strategy. Should something happen in the economy where you're not caught with your underpants down at your ankles, you're able to still cash flow, ride the wave out, and then continue on with the business plan and eventually exit at the higher multiple.
Yeah, yeah. That's interesting. It's interesting you said that. I mean, don't you? Well, okay. I'm just thinking about how that is true. If somebody wants to buy it for the right amount of money, you'll sell it. If you can if you can create enough added value, you will. Then you'll refi, pay everybody what they put into it, and then just cash flow the hell out of it until it's time to sell or stay on forever. Yeah, I love that. And you guys don't buy shiny pennies. You buy things that have possibilities of added value. Is that correct for the most part?
Right. We're not buying like beat up properties. We're buying properties where the owner has some kind of distress. So like, I think like the equivalent for your guys' business, if you're looking for another pizzeria, right? They're making money, they're okay. But you walk around, you're like, this is a piece, it's dirty. There's obvious management inefficiencies that you can change, low hanging fruit. That's the type of properties we like to buy for a couple of reasons, right? We get non-recourse debt. Fannie Mae, Freddie Mac love us for buying these types of properties. We get great debt when we go after these assets because it's low risk properties for them to lend on. And another thing is like we can, we buy these things at a discount, right? Because when the owner has that type of distress, that's where we make money on the buy. So it's like instead of normally the example I say is like we're buying an existing lemonade stand that's already making money, and we know we can do several things to jazz it up a little bit and put a little lipstick on a pig and extract that value and eventually sell or refinance the value out.
Lane, how many how long before you quit your engineering job? How many units did you have at the time?
I quit maybe a few years ago. I don't know how many, maybe a couple thousand units at the time. But like I think like going back on my story, like I started in private, working for private companies, which are more high stress. You learn a lot more about business and just
Yeah.
handling in the oven a little bit hotter, right? But eventually, as my portfolio grew, 11 units, and it started to get into apartment complexes, I started to find jobs that were a little more cruise to afford me more time to spend my time on what actually really mattered, which was the real estate investing. So I started to kind of find those types of jobs. That's why I kind of stuck around at my job longer than I should have. I'm definitely one to, I believe most people should start, their side gig on the side of their job for many reasons. One being like they can, create business systems while they're short on time, right? If they're working as a day job, they're going to get really lean and create good business practices. So when they are finally quitting that day job, they unleash the beast at that point and they kind of get off rolling. And the other reason was like most people fail. So you have that day job to go back to.
Yeah, you weren't sure yet, but then, I mean,
Yeah.
it must be hard. I can only imagine going back to work when you got, 1,000 units and you're like, holy shit, I got to deal with this asshole. He has no idea.
Yeah. I mean, like 4 or 5 years in like working as an engineer, I mean, like I was working for a really bunch of jerks, very conservative company. And I don't know, kind of like it was difficult because like I was like, I'm making more money than you, dude, and you didn't even know it, and
Yeah.
like don't tell me like you don't know about money. Like you can't even run your personal finances at home. Don't tell me I don't know about money, right? Eventually I left that company because I got sick and tired of it. But like, I mean, most people working in middle management, corporate America, they're not there because they're shining characters and because they want to. They're there because they're stuck. Because they do what we're all brainwashed to do: put your money in this 401k, in this garbage investments, and work for 40, 50 years. I think when you're an entrepreneur, you start to partner up with people. You start to realize you found people on your trajectory. And I just think generally you get along with them and you are eye to eye with them, right? Than the people that are stuck in corporate America.
Yeah.
Again, they're not there because they want to be.
Yeah, I mean, and you see it. You watch these people. They're bitter. They're unhappy. Not all of them, but a lot of them. They're just like you said, stuck, and you almost feel bad, but they're so mean that you can't. They're so miserable you can't even feel bad for them. It's hard for me to feel bad for it.
But again, like kind of we're talking about, right? The whole concept of like putting your own oxygen mask on. Like I forgive them. Like when you only have one income source that's making $120,000 a year, you get fired any moment. Yeah, you're backstabbing your coworkers so that your family can have a good bonus that Christmas. I totally get it, right? And that's where it's moving from that scarcity mindset to the more abundance mindset. And if you have the money, why hang out with those people, right?
Yeah, definitely. What do they say? You can. You're the sum of your closest 5 people you surround yourself with, or 10 people, maybe.
Exactly.
So you're living in Hawaii, but that's because your family's from Hawaii.
Yeah, and most of the stuff I do is online. A lot of it is some traveling here and there, but nice weather. I used to live in Seattle. It's too cold up there.
Yeah, rainy. Are you married? You have family?
Yeah, one kid.
Nice.
So that's kind of getting life a little bit more busier these days. A
Sure.
lot more complex. Can't just think of myself all the time.
I know. So are you a reader? Book reader?
Not really. I mean, I kind of just like do my own thing. I mean, I try to read, but it's just like there's kind of two people in life: people who consume content and people who create it. I mean, I'm just too busy writing and blogging and podcasting for simplepassivecashflow.com.
Yeah. You got a very, by the way, I just want to tell you real quick, you made me laugh hysterically with your video. Is very funny at the end, the song you sang. I don't know who's saying that song.
Yeah, that was me.
It was like a serious thing, and all of a sudden it turned into this little funny little ending, and it was pretty funny. So I actually laughed out loud. I just want to give you that a little hit there. And simplepassivecashflow.com. Lane, I really appreciate you coming on. You've shared your knowledge, your history, your story. I really appreciate it, and I want to keep in touch after this podcast. And who knows, maybe we'll do business together one day.
Yeah, appreciate it, John. Thanks, everybody.
Thank you, Lane. Have a great day.
All right, you too, man.
Take care. Bye-bye.